All right, y'all. I mean, um, I've been doing these about once a month, and I'd prefer not to. Good investing is kind of like watching ice melt. In an ideal world, we just kind of make good business decisions and we live with the gyrations of the market. But what we're in the midst of right now is beyond a simple gyration. It's beyond a bad week of trading. Last week was the worst week of trading we've had in since the coronavirus, and we are now officially in a bear market. Um, Being as though that I've been doing these once a month, you can go back and look at the last two recordings that I did. They've actually aged okay, which you run a major risk if you produce financial commentary content and then you let it live in the ether. You run the risk of having to eat your hat. But honestly, the advice that we were given a couple months ago and the advice that we gave last month, you're going to notice it hasn't changed tremendously. We just have a little bit more data to share and some more, shed a little bit more light as to what's been happening as of late. So, anyways, we're officially in a bear market. Here's our compliance slide, so I stay in the good graces of Paige. So everyone take a couple minutes to read every word on that particular slide. Don't miss a single letter. Okay, there we go. All right, so this data was pulled as of last week. The market's popped up a little bit today, but year to date, the S&P 500 is down 23%. The NASDAQ, mainly technology stocks, is down 32%. And what makes this particular bear market unique, typically when stocks go down, bonds typically at least hold their own or go up a hair. There's kind of an inverse relationship between stocks and bonds. Not so much the case this year. The bond aggregate, as represented by ticker AGG, is down 12%. That, of course, is because we've seen interest rates climb quickly, over like 150% in the last 6 months or so. So bonds are even down 12%. And then finally, the crypto 200, which I didn't even realize was an index until I put this presentation together. So I'd imagine that's the 200 biggest cryptocurrencies by market cap, down 62%. That's where a lot of the blood and red on the streets has been coming from. The most innovative, forward-thinking technologies, so blockchains and decentralized finance and 5G and the metaverse, electronic autonomous driving cars. Cathie Wood's ARK fund is down 60% year to date. And that's typically the case when you're heading into a recession, right? What made coronavirus so unique was the stock market dropped 35% in 21 trading days, and all of those innovative technology, futuristic companies actually outperformed all the big, boring, steady Eddie, cash heavy companies. Well, not so much with the bear market that we're in right now. Those technologically advanced companies that have all of the innovative, creative ideas, but not the cash to back them up, are bearing the brunt of what we're witnessing in the market right now. Spam phone call right on time. So what makes this pullback so egregious for retirees is the slide you're looking at right now. Typically, retirees, if you subscribe to modern portfolio theory, will say, hey, I'm 60 years old, I'm 70 years old, I ought to have 40, 50, 60% of my money in bonds. Take a look at this. This would be a 50-50 stock bond index fund allocation as represented by Spiders, SPY, and then the bond aggregate index, AGG. Year to date, you're literally down 17.5% by having a 50-50 allocation. We've encountered a number of individuals who had all of their money in a target date retirement fund within their 401k, thinking they were being cautious. We're talking target date 2020, target date 2025. And those funds are down double digits year to date because of what's been happening with bonds. What if you were ultra conservative and you put 90% of your money in bonds and only 10% of your money in stocks? Well, you'd be down 13% year to date. We have never seen anything quite like this. I haven't seen it throughout my career where what would be deemed to be a conservative portfolio is getting slaughtered the way it is year to date, mainly because of what's been going on with interest rates spiking the way they have been. So there's a lot of individuals out there who think they're being cautious, and they're seeing their portfolio balances down double digits because of the couple slides I just showed you. This might give you a little peace of mind. So this is a pictorial laying out the history of bull and bear markets since 1926. And what you're supposed to glean from this is markets take the stairs up and the elevator down. Bear markets are usually very aggressive and very quick and very short in duration. In fact, the average bear market only lasts about 1.4 years, and the cumulative loss on average is about 41%. You just saw we're only down around 23% on the S&P 500, so there could be some more red in the streets headed our way. But to maybe make yourself feel a little better in all of the doom and gloom is bear markets are usually very, very short. They look like little orange blips on this chart, whereas the blue chunks of time are bull markets. You can see most recently 8 years, 5 years, 12 years, 12.9 years, whereas the bear market's 3 months, 2 years, 1.3 years. Now, let's look back at the bear markets that are still very fresh in our memory. Think back at 2008, the financial crisis. Some of us will never, ever forget that. But if you recall, the financial crisis was really isolated specifically to the financial industry and the real estate industry. But of course, the financial industry has tentacles that like breach out into all the other industries that are out there. But if you remember, it was spurred because financial companies created innovative products that used the leverage, massive amounts of leverage, and they were basically bouncing these products back and forth like a volleyball or playing a game of musical chairs. And eventually the music stopped, and credit default swaps, credit default obligations found themselves on the balance sheets of 150-year-old investment banks, Bear Stearns, Lehman Brothers, Citigroup. And because they used leverage within these products, they created so much in liabilities that the companies didn't have the assets on their books or projected to satisfy how much liability that they created. And go figure, they all went bankrupt. And also during that time frame, the Federal Reserve stepped in and kind of FDIC stepped in and act as like the broker of bad banks. So that's when you saw Bank of America and Merrill Lynch become dancing partners, and JP Morgan and Chase buddy up, and Wells Fargo and Wachovia buddied up. And if you remember what happened on the heels of the financial crisis, the Federal Reserve stepped in and they did quantitative easing 1 and quantitative easing 2 and TARP and HARP and a bunch of other four-letter words. And the net result was about $800 billion of money printing. And that was unprecedented at the time. In fact, I was going, oh my gosh, we're going to have runaway inflation if they print $800 billion. Go figure, we had no inflation through most of the 2000s and up until recently. And the stock market popped right back up. Literally, we're down close to 40% for the year 2008. And within about 2 years' time, you're back to an all-time high on account of the Federal Reserve doing all those monetary easing and money printing. Fast forward till 2020, which we all remember, the coronavirus bear market. This is where the market dropped 35% in 21 trading days. The Federal Reserve and the U.S. government stepped up and printed $8 trillion because $800 billion wasn't enough. We decided to go 10x what we printed during the financial crisis. $8 trillion, and a year in which the market's down 35%, we finished the year up 18.4%. And then, of course, 2021 was a magnificent year in the market as well. S&P up over 28%. The problem that we face today is we can't exactly print money and throw it at this recession and throw it at this problem. That would be like squirting lighter fluid on a wildfire. That's not exactly accomplishing what we need right now economically. We kind of need to throw sand or water on this thing. So the Federal Reserve scratching their heads saying, I got to raise interest rates, and everyone's hoping for a soft landing. But what we're in the midst of right now reminds me a lot more to what we experienced during the dot-com bubble. And the dot-com bubble, if you remember, was a unwinding of overly appreciated stock prices. We had pets.com, which was essentially a URL, which had a market cap in the hundreds of millions of dollars. You had all of these innovative tech companies that really had no revenue, no profits, and they were getting priced through the moon because everyone just kind of wanted to get a taste of them, kind of similar to what we talked about earlier in the presentation, cryptocurrencies, blockchains, 5G. A lot of these companies have really great ideas, but they got no revenue backing them up. So what we experienced during the dot-com bubble, because the Federal Reserve wasn't able to just throw money at the problem, is we had a 3-year bear market where we experienced double-digit negative rates of return for 3 years in a row. If you can believe it, the dot-com bubble was 22 years ago. So I think sometimes people forget that, hey, not every bear market gets solved in 1 year's time after the Federal Reserve throws money at it. We very well can be in store for a prolonged period of time where we have a sluggish stock market. If you look back at one of the presentations I did last month, we talked about Vanguard's Market Perspectives Outlook, where they do a 10-year forecast of where they see various asset classes. And they projected U.S. equities to only grow to the tune of 2 to 4% per year over the course of the next 10 years. That is the most bearish outlook Vanguard has ever had. Fidelity echoed that very same sentiment, as well as Schwab and JP Morgan. All of these large asset managers are all coming out and saying, hey, you shouldn't anticipate the same rates of return for U.S. equities that you've grown accustomed to over the last 10 or 20 years, because the Federal Reserve needs to increase interest rates, because we have inflation that might not be solved overnight, because we still have COVID and different variants popping up here and there, because there's a war going on in the breadbasket of Europe. All of these things that are clouding our headlines right now were all cooked into Vanguard's Market Perspectives forecast. So I'm kind of sounding the alarm that this could be a prolonged bear market. And it's funny, I'm going to show you a couple slides next that I've been saying, hey, I think we're in the first or second inning of a recession for a while now, because ultimately 70% of the American economy is driven by the consumer. And I think sometimes when you look at Wall Street in particular, the epicenters of Wall Street, New York, Philadelphia, Chicago, San Francisco, these are kind of hoity-toity city slicker types. And then you look at where our legislation is getting passed on the federal level, Washington, D.C., which is one of the most wealthy areas to live on the face of the earth. I think these people are a little bit divorced from reality. They're divorced from what Main Street Americans are up against right now. And they're addicted to just getting on soapboxes and making statements on network television. So you'll know, you're starting to see the CEOs of the big banks come around and go, yeah, it might be a recession. Maybe it was just their job to remain optimistic. But now you're starting to see kind of dominoes fall, where all the talking heads are starting to go, yeah, we're probably are falling into a recession. Take a look at this. This is the median household income in the year 2020. This is the latest data that we have from the Census Bureau. $67,000. That's a gross household income. Now, what does $67,000 look like on a biweekly basis after the government takes their cut? You pay your FICA taxes, so some of it goes towards Social Security and Medicare. $67,000 a year is only $2,000 every 2 weeks. That's without making a contribution to a 401k plan or a retirement savings account. And that's without paying for your health insurance. So this is assuming that your employer pays all of your health insurance, which is very rare. Most everyone pays a little bit for their health insurance. And I would hope, if you're watching this, it's because you did this, but I would hope you're putting a little bit aside to build up your nest egg in a 401k or an IRA or something like that. So literally $2,000 every 2 weeks with a median household income of 67. That's household income. That's not per person. That's for the house. So you got to ask, what is the average household budget in America in the year 2022? $50,000. That's after tax. And that number has never been higher because of increases in housing prices, increases in transportation prices, whether it be gasoline or whether it be just the purchasing of new vehicles. Food prices are through the roof. Then you got to factor in personal insurance and 401ks and such. Here's healthcare costs, and then cash contributions. And then you have all these other little things in here as well, which we're just shining a light on kind of the biggest expenses. So we talked about this in a webinar that we did. Gosh, it was over 2 years ago. We're sounding the alarm that inflation is going to hit. Here are the sectors or the segments of the consumer price index that are through the roof. Gasoline, this is just 1 year, March 2021 to March 2022. Gasoline's up darn near 50%. Used cars up 35%. Hotels and motels up 30%. Airfares up 23%. And so on and so forth. When you look at a medium household income of $2,000 every 2 weeks, but then baseline necessity costs of $50,000 a year, it doesn't take a rocket scientist or an Ivy League educated economist or someone who's spent their entire career at the Federal Reserve to recognize that money only goes so far. There's just not a lot of wiggle room for most Main Street Americans. So naturally, if Main Street Americans don't have surplus capital and surplus cash, they don't have the ability to spend it, and they don't have the ability to stimulate the American economy. So that's why I believe we are, in fact, in a recession. They just haven't declared it yet. And of course, a recession is just a dictionary word for 2 quarters in a row of negative GDP growth. I believe we've already had 1 quarter announced. So we're just waiting on another quarter to hit the ticker tape. Take a look at this. I saw this cartoon on Twitter, and I said, yeah, that's probably about right. Here's the Grim Reaper knocking on stock's door, leaving a trail of blood, then cryptocurrencies. Now he's knocking on the door of the real estate market. I was with a real estate investor a couple weekends ago, and I was just talking about how the stock market was crashing, and this guy was like piously saying, well, that's why I invest in real estate. And I kind of wanted to say, hey, buddy, don't you realize that the stock market is a leading indicator for the real estate market? And I know we probably have some real estate investors and real estate agents on this webinar, and you guys are going, well, the inventory, supply and demand, and everyone wants a piece of Charleston. And yes, that is true, right? We're in a bit of a bubble here in Charleston and Myrtle Beach and Hilton Head, and we're in a desirable part of the country, and they're not making any more dirt. And naturally, we're going to be isolated a little bit. But look at these 2 things I circled down below. This is a mortgage calculator where we're looking at a $500,000 loan. And literally a year ago, you were able to get a 30-year fixed loan around 2.5% at the lows. This is 30-year fixed mortgage rates right about now. They're pushing 6%. So that very same loan 1 year later is literally going to cost you $1,000 more per month. And like it or not, that's how Main Street middle-class Americans budget. They look at their budget on a month-by-month basis. Most of them don't have gobs and gobs of surplus cash that they can, just throw at a mortgage willy-nilly and actively pay it off. Most people are doing the Dave Ramsey every dollar budget, going, okay, my income is this, your income is this, and we can afford this much house. Well, you're pricing out a large segment of humanity when you're seeing monthly mortgage costs going up $1,000 more each and every month because of what's been going on with interest rates and in turn mortgage rates. And none of this is modeling in the chance that companies stop hiring or slow down hiring or start laying people off. Amazon had an awful quarter. There's a paper that just got released that talked about how Amazon overhired. Heck, our little company, we probably overhired a little bit because we saw the business scaling up. Now I'm looking at, the lay of the land going, well, I don't want to have to lay people off. We need to be a little bit more cautious about bringing new people on. So it hits and I'm just a little rinky-dink financial planning company. Imagine what the brass over at Boeing or Volvo or BMW or these large local employers are thinking right now. You got to believe they have economists on staff and they're adding all of this stuff up that I just shined a light on and going, yeah, maybe we need to do, shed some payroll by attrition and not rehire, or maybe we got to do a small layoff. That could have a huge impact on the economy as well. We haven't seen that yet. The labor market right now is what the White House keeps shining a light on. They're acting as though the economy's never been stronger because the labor market is so strong, which is 100% accurate. But eventually all of this stuff starts to add up and it will have an impact on the labor market. So what are our bear repellents? I can't help but look at this slide and say, poor bear. He's probably just going for a walk, munching on this evergreen tree, and these dingbats spray him in the face with bear mace. But so what do we do to protect ourselves if we are in fact in a prolonged bear market? All right, what to do in a bear market. So if possible, now, if you work with us, I don't want you to look at this slide and go, oh no, Adam's telling me to stop taking retirement income, because you're going to see in a second, your portfolio was built for this. You do not need to suspend your monthly distributions. Now, there are some of you, though, that the way we design retirement plans as a firm is if you say to me, hey, I need $5,000 a month, what we like to do is game out your financial life and go, well, if you live off of $5,000 a month, by the time you're 90 years old, you're going to have $2 million. Is that a life well lived? Wouldn't you rather just have $1 million at the age of 90? Do you want to be the wealthiest person in the cemetery? Naturally, people go, no, my mommy and daddy gave me nothing. I'm not giving my kids anything either. Or I want to give them enough, give them a hand up, not a handout. So naturally, people say, yeah, send me a little extra income. Send me a surplus income above and beyond what I actually need. And naturally, what happens is when you send people surplus income, their cash reserves build up, their emergency funds build up. And if you're one of these individuals and you're going, I got $50,000 sitting in cash, well, now would probably be a really good time to reduce or even suspend your monthly portfolio drawdowns. And you can just lean into our office and go, hey guys, I watched the webinar. I'd like to stop those distributions until further notice. Or, hey, I've got 30 grand sitting in the bank. I think I'm going to live off of that for 3 months and then restart my monthly distribution. It's all about kind of tightening your belt and conserving when everyone's running for the exit and the market's crashing the way it is. Now, another thing that we're automatically going to do for you as a firm is we typically sit for our clients that are taking monthly distributions or drawdowns. We typically like to sit on about 3 months of cash anyways. That way we're never disrupting or selling something in a squirrely market. But if we do have to begin raising cash within your accounts as to satisfy your monthly distributions, what we're going to do is thoughtfully sell investments that have little to no losses, right? So most all of our portfolios have a chunk of gold in them. Gold is one of the only asset classes that has done okay year to date. A lot of dividend stocks have held up marvelously year to date. The last thing we want to do is sell, Amazon and Microsoft and Google and Apple, all stuff that are down 50% year to date. We're going to want to pull your distributions from things that haven't realized the types of losses that we've seen in other segments of the market. So another thing to do in a bull market or bear market is just be thoughtful as to which investments you sell, which investments you pull your income from. Be patient when purchasing big ticket items. Now, I know some of you guys just retired and you're like, I want to get the RV and travel across the country. Well, we work with a lot of individuals who live in an RV, and I'd be happy to share their name and number with you if they'd give me permission, and they can share how much it costs to fill up their RV and gasoline right now. That might deter you from wanting to buy an RV. But high-end real estate, the lake house, the ocean house, you might want to drag your feet a little bit. Like, I think a lot of weak hands, unfortunately, recessions, the stock market in bear markets, you can see that crash happen quickly and it begins to rebound quickly. But the actual economy and the stock market are somewhat, there's a parity there. And oftentimes it takes a little while for things like real estate and big ticket items to come back down to earth, because naturally the people who own that real estate don't want to believe it. So, if you have a lake house and it's your second house and say your spouse loses her job, it takes a lot. You play a lot of mental games with yourself where you go, no, we'll get out of this in no time. We'll get out of this in no time. And then eventually it becomes very apparent that, okay, I need to sell this place. And that's where you want to be the buyer, right? You don't want to buy in the first or second inning of a recession. You want to buy in the doom and gloomiest part of that recession when people have no hope and they're forced to sell because of economic circumstances that are out of their control. Now, I hate profiteering off other people's misery, but that's what the market is. The market is a place where patient people separate, or impatient people are separated from their money by patient people. So right about now, you want to be patient if you are in the market for expensive big ticket items. Now, if you own a lake house and you've thought long and hard about ditching it, or you own what was once a rental property that you bought for $200,000, but now you can fetch $400,000, but your rent hasn't changed all that much, and you're essentially in the low-income housing business all of a sudden because you haven't been raising rent aggressively enough, or that area that was once really prime for rental is now becoming a neighborhood of primary residences, might be a good time to sell that type of real estate. Certainly high-end real estate, I think, is probably will bear the brunt of it. Second homes and things like that will be the first thing that get hit if we are, in fact, a prolonged recession or prolonged bear market. All right. So from an investment standpoint, this is what we're advising. Make minor tweaks to your financial plan. Don't reinvent the wheel. Just make subtle course corrections. Not a day passes, especially this last week when there was so much negativity out in the market, where people are going, Adam, should I sell everything and put it in cash? Or Adam, should I take everything out of that like the top of the pyramid high risk account and put it all in the guaranteed fixed rate account? Like, people want to make brazen, brash reinventions of the wheel, take it all from here and plop it all down here. And I think that's chasing returns. That's a recipe for disaster. But that also doesn't mean, the most common thing that comes out of financial advisors' mouths during financial crashes like this is hang in there or it'll come back. I think you should be on your toes. I think you should make thoughtful course corrections. But that doesn't mean you completely sell out of everything and push it into cash, or that doesn't mean you sell out of all your fixed stuff and try to go bargain shopping. So the three most popular trades that we've been advising and talking to our clients about, again, we've already discussed these in previous presentations. So go back if you want more context on each one of these trades. And I think what you'll come to find is, our investment advice is not changing all that much, right? It's been the same for a long while now, but it's worth shining a light on what we think is a thoughtful place to tweak things right about now. The flight to safety trade. Now, some of us were seduced by a bull market, and we grew accustomed to see number go up and we wouldn't dare had put our money in a 2-year CD or a 3-year fixed annuity, because 2 or 3 years ago, a 3-year fixed annuity might only been paying 2.4% or something like that. Well, now we're seeing 5-year accounts paying 4%, 2-year accounts at 3%, 3-year accounts at 3.7%. And a lot of individuals who were seduced by a bull market and kind of fell in love with the market are now beginning to realize how adverse they really are to taking risk. So what a number of individuals who work with us have elected to do is whittle down a chunk of their stock exposure, and that might be 10 to 20% of their portfolio, and shift it, as we say, down pyramid into things that are going to be a little bit more predictable. Let's say, case in point, a really popular financial move I've done with a few of the people I get to work with. They're looking at the administration right now, and this isn't a political webinar, but might as well be. And they're going, I'm not seeing a lot of thoughtful solutions right now coming out of Washington on how we quell inflation. I'm seeing someone gloat about how strong the job market is. I don't feel good about the future of our country because of leadership. Well, why don't you take a chunk of your portfolio, put it in something that's going to be predictable and secure, kick the can down the road 3 years, and by that time, we should have a pretty crystal clear understanding of, was this a dot-com bubble 3-year double-digit negative rates of return all over again? Do we have a new administration, new cheeks and seats in Washington? Has inflation calmed down like Janet Yellen has said it was going to calm down for the last quarter, several quarters in a row? Remember, inflation was supposed to be transitory. Well, she's since come out and said, yeah, I was wrong on that. So might be a good idea to shift some things into things that are going to be a little bit more predictable, kick the can down the road with a little bit more surety for a few years. Now, I wouldn't go longer than 5 years. I'd keep these in very short-term chassis. And of course, linked rates. These are accounts that we've always been a fan of. Market-linked CDs, fixed index annuities, I bonds. Mike here in our office did a YouTube video on how to buy I bonds. They just had a 9.6% guarantee for the next 6 months, and it's a little misleading because you don't get all 9.6. It's 9.6 annualized, and then come November, they're going to change the rate on you. But we love linked accounts. They have always been a major part of our practice. And because we use fixed and linked accounts, most of the individuals that we work with are not seeing the types of rates of return I shined a light on at the beginning of the presentation. Now, certainly the things that they have in the market in bonds and stocks, there's really nowhere to hide. The only way we could have avoided all losses this year is if we put all of your money in gold, which would have been a foolish decision because, as you know, gold is a kind of a stagnant asset. It just, all of the world's gold would fit in an Olympic-sized swimming pool. So there's something to be said about scarcity. But it would just sit there and glisten. It wouldn't pay you dividends, wouldn't pay you interest, wouldn't pay you rent. So we use stocks because we know it's a great way to grow money over a long period of time. But part of investing in the stock market, we must suffer these events where everyone runs for the exit periodically. So fixed and linked rates might make sense to shift a chunk of your portfolio into things that are going to be a little bit more predictable. Second transaction that we're talking to a lot of individuals about is shifting your money into dividend paying stocks. Up until last week, we run a model in-house. It's called our dividend driver model. It pays darn near, I think it was like 4.8 the last time I looked at it. Probably after what happened last week, the yield is around 5% per year. But of course, with dividend investing, this is a chart of Johnson & Johnson. And if you look at this thing under a microscope, you'll see massive gyrations. It looks like an EKG reading. You're down 7, you're up 15, you're down 21, you're up 30, you're down 10, up 10, down 11. So if you had hundreds of thousands of dollars in a portfolio like this, you would literally see tens of thousands of dollars appear and reappear on a month-by-month basis. But when you own a company like Johnson & Johnson, or you own a company that pays a good dividend yield, you're less focused on what are called the paper gains and paper losses, and you care more about your consistent, predictable dividend payment, as indicated by the D's here at the bottom of this particular slide. You invest in dividend stocks not so much to stare at your big number on the statement go up and down, because if you kind of squint your eyes and you take a step back and you look at a chart of Johnson & Johnson, it looks like a 45-degree angle. There's just a lot of chop if you look at it under too big of a lens. So dividend investing makes a ton of sense to us. And this is not to say you can't lose principal in dividend stocks. Our dividend model, I think Frank told me, was down like 8% last week. So dividend stocks, you'll see your account value gyrate. I think people were spoiled because we've had an emphasis on dividends for a while now, and most of our dividend models have held up really, really well, with the exception of last week. The other takeaway with dividend stocks is, by and large, most companies that pay dividends are cash-heavy, big, solid, stable companies. Our dividend driver model, you can see some of the makeup of it right here. We literally spread the risk across, my gosh, probably 300 to 500 different companies that showed an ability to consistently pay their dividend, in many cases increase their dividend. Dividend aristocrats, as they're called, is one of the components within it. So that's a transaction we've been talking to lots of individuals about. Shift some of your portfolio into things that have a heavier emphasis on dividends. Finally, I saw this piece in Market Watch, the bargain shopper trade. And it says, those who buy stocks the day the S&P 500 enters a bear market, which was like last week, or maybe it was the week before, have made an average of 22% over the course of the next 12 months. Now, I'll give you the cliff notes so you don't have to read the article. This guy looked back at all of the bear markets since the end of World War II. So that's about 75 years. There's been about 12 bear markets, which equates to one every 6 years or so, little 6.5 years or so. And in only 2 of the 12 bear markets since 1945 have stocks been lower 12 months after the bear market was announced. Only 2 of 12. So literally 10 times out of 12, the day the stock market hits a bear market, 1 year later, stocks are higher. I was trained on this thing called game theory when I used to work on a trading desk, and those are pot odds. That is a pretty strong probability that stocks will be higher. And in the case of those 2 of the 12 where stocks were lower, had you just hung in there, you would have been higher in very short order. And that's easy to predict simply by looking at, the chart of the S&P 500. So some of you might be licking your chops going, they just announced the bear market a couple days ago. Now would be a good time for me to go bargain shopping. I want to shift my bonds, which are down 10%, into things that are down 30%, like the names you're seeing here. One of the largest holdings we own as a firm is a Vanguard Growth Index Fund, ticker VUG, Apple, Microsoft, Amazon, Facebook, Google, Tesla. This thing's down 30% year to date. So you might shift dry powder cash. You might shift bonds, which are down, like we said, but not down nearly as much as this type of stuff, into things that are on sale historically. Now, again, course corrections, not chop with an axe, completely redesign your portfolio. Subtle tweaks within your allocation. Take 20% from the safe stuff, shift it to the top of the pyramid. Now you'll notice I basically just gave you 2 pieces of advice, which couldn't be more polar opposite. Do you want to play it safe, or do you want to go pedal to the metal and go bargain shopping? Financial planning is both quantitative and qualitative. I have some individuals that are freaking out going, Adam, don't lose me a penny. Naturally, we're not going to buy them Apple, Microsoft, Amazon, Facebook, and Google. We're going to put them in things that are very, very predictable. Some people have been through 12 bear markets. Now I'm dating you right there. That would mean you're over 75 years old. But you recognize markets pop and drop. You don't get too caught up watching the men wearing makeup scaring you to death on business channels, and you just recognize that this is a great opportunity to scoop up bargains. So lean into our company, plan with us. Let's review your plan, and let's talk about these trades that we find to be, thoughtful right now with what's going on. I shined a light on this model that we created recently. We call it our turbo model. This is all of those high octane, pedal to the metal, innovative things that are priced right now at deep, deep discounts. You can see one of the largest holdings inside of it is Kathy Wood's ARK fund. This thing is down like 70 or 80% from its high. You can see the NASDAQ's in there, financial technology, electronic and autonomous driving cars, the metaverse. You've got some high yield real estate debt in there, private equity companies. So if you're licking your chops going, right now might be the opportunity to fortunes are made in bear markets. I want to take a chunk of my money and go bargain shopping. We've got a model specifically designed for you. So finally, this little corny drawing, if you work with us, you've seen it a million times. It's built my entire company. This simple pictorial where we help people visualize how they're invested, what we call an asset allocation pyramid. It works. It works. And one of my takeaways as someone who manages money in this environment, and the message that I've been getting across to the people who work in our company, it's become very clear to me that the individuals who kind of steamroll us and say, no, Adam, I don't want it to look like this. I just want the middle one, or I just want the top one, or I just want the bottom one. Those are the people who are typically the least happy when markets get squirrely. The folks who we work with who, and granted, everyone we work with is a little bit different. So this is not to say like, hey, just let us do it. We want you to be involved in your allocation. But when people start cherry picking which thing they think is going to do best, like it's a cafeteria style menu, and I just want to eat beans, I don't want to eat any fruit, and I don't want to have any protein, although I think beans are protein, bad analogy. That lends itself to you chasing returns. That lends itself to you kicking yourself. And when you allocate your money, as we advise, you're not necessarily betting you're going to be right throughout all market conditions. You're just betting you're not going to be wrong, right? So folks who work with us and have a bedrock of stability, if this market keeps crashing, if it's a 3-year bear market, if it drops another 30% and we have a 50% crash, well, you need not lose a wink of sleep, because we'll just pull your income from things that are principal protected. We'll pull your income from your fixed and your linked accounts. And we put money in the middle column, our SWAN model, our dividend models. The SWAN model we've been kind of whittling down on, but we still believe in that SWAN model. If you look back at a chart of how that SWAN model would have behaved over a long period of time, it does exactly what investors are looking for. Hey, if the market crashes, kind of pull some of my money aside. If the market goes back up, push me back in. When the market gets really choppy, it kind of throws a wrench in it, which we're seeing at the beginning of this year. Come January, the market was crashing. We got out and we kind of got back in. Now we're back out. That model is almost completely on the sidelines right now. So dividend stocks. And then finally, take a page out of the book of Warren Buffett or Dave Ramsey. Buy and hang on for dear life. The only way we get hurt on a roller coaster is if we jump off mid-ride. If you're freaking out about the market, turn on Dave Ramsey. He's on your radio dial every single day of the week, and every person's calling him up going, Dave, all my mutual funds are down 30, 40%. What do I do? And he's just going, so what? Hang in there. So what we believe is all of these investment theses, all of these philosophies hold merit. They're useful. They work, but none of them are perfect. So what we're doing is very common sensibly melding them all together and recognizing that none of us are all that unique with what we want our money to do. We want it to grow. We want it to be safe. We want it to be liquid. And none of us like paying taxes. And everyone go, Adam, you seem like a nice guy, but I don't like paying you a bunch of money in fees. We want to keep our fees as low as humanly possible. And there's really only way to do that. The only way to do that is to layer and ladder multiple investment strategies as to get the best out of all those different worlds. So if you're working with us, rest easy knowing your portfolio was built for this. It works. If you were working with us and you go, yeah, Adam, a year ago, I couldn't stomach the idea of locking up my money for 5 years and putting it into something that was only going to make me 3.5%. Well, that's okay. You don't have to come back. We're not going to say I told you so. Just lean into our office. Let us review your portfolio. Talk about what we feel is a thoughtful and sensible way to allocate money in a very, very uncertain time, because it works. It works. I believe that in my heart of heart that it works.